Hello, good afternoon and good evening. And on behalf of CFA Society Emirates, welcome to today's webinar, The Global Investment Backdrop and Its Implications for MENA. My name is Rahul Shah. I'll be your moderator for today. Our main speaker is Mehran Nakhjavani. He is a partner at MRB, the Macro Research Board, and he specializes in emerging markets and oil-producing economies. I think given what's happening today in the US, this is a well-timed presentation, and we will be very interested in what Mehran has to say. Following Mehran's presentation, we will open up for a Q&A. Please submit your questions using the chat function on your screens. Mehran, if you could just move forward a couple of slides. I just wanted to say a few quick words about CFA Society Emirates. One more, please. Thank you. A lot of you will be familiar with, sorry, if you could go back one.
Yes, I thought so.
Okay. Okay, perfect. So a lot of you will be familiar with what we do, but some of you on this call may not. So just to give you a brief introduction, we are the largest CFA society in the MENA region. We offer a range of services to our members, ranging from strategic events, such as our forecast dinner, and I would argue this event also, educational events for our students, but also for full-time members. And this talk will qualify for professional learning credits, for example. We offer career support in terms of a lot of events that we host in terms of career development. And there is also a facility for searching for jobs on the CFA website. And then finally, we try and keep in touch regularly with our members. You'll be receiving emails both from our locals chapter, but also from the Global Institute, and we welcome a two-way dialogue. Happy to take more questions on that at the end of this presentation if you have any, but otherwise I'd like to hand over to Mehran. Call is yours.
Thank you, Rahul, and welcome. Good afternoon and evening to everybody. Thank you also to the CFA Society of the Emirates for setting this up and everybody involved in doing that. I'm addressing a number of different issues today, broadly speaking, under the rubric of the global environment and its implications for MENA. The first question I want to tackle, this is just a brief one, which is that how should you incorporate views and scenarios about the current pandemic, the COVID-19 pandemic, into an asset allocation framework? I mean, should you even be bothered about it? And in that context, then, just very briefly, let's make a couple of what I think are important points to remember. The first is, it's not the number of deaths or the number of infections that matters. I'm sorry, that sounds very cold-hearted, but I'm referring to the economic consequences and the asset allocation consequences. It's not the number of deaths or infections that matter. It's the public health countermeasures that are put in place to control the epidemic. That's what actually has a massive economic impact. In other words, this is not a pandemic which is killing so many people that the deaths are in themselves causing the economy to slow down. What's causing the economy to slow down are the various quarantine measures or social distancing measures, right? So it's the public health countermeasures, not the number of deaths and infections. Now, a lot of people get completely sidewhacked by that, by looking and obsessing about infection rates and assuming that that means that the public health countermeasures will follow. It doesn't necessarily follow. In the first wave, we had, with relatively small numbers of infections and deaths, we had quite severe countermeasures, which had a significant economic impact. In the second and third waves, we are seeing a completely different pattern emerging. The numbers of infections are rising, but the countermeasures are not necessarily being put in place in the same way. Why? Because countries simply can't afford the economic cost to do that. So that's the first point. Second point, what really matters for asset markets and for asset allocation decisions is not the actual countermeasures, or indeed the deaths or infections, but the monetary and fiscal policy responses. So the what is policymakers have done in the face of a public health crisis, instead of coming up with a health solution, because there isn't a health solution. What is the health solution? It's a vaccine or a therapy. Well, we don't have those yet. So in the meantime, as a stopgap, what they come up with is easy monetary policies, extremely generous fiscal responses. So it's these policy responses, the monetary and fiscal side, which have the impact on asset allocation, because monetary and fiscal responses are generating very, very significant quantities of liquidity, and that impacts asset allocation. So that's the way to think about it, not to be obsessed with the actual infection rates. Now, having said that, we at MRB, as a public service, you can go to mrbpartners.com and get this for free. It's available to anybody, not just to our clients. We produce charts on a daily basis that track. I'm just giving you some summary charts here, which track the numbers of infections. Now, a key insight is here on the bottom left. If you can see that, that's a diffusion index. Now we calculate that diffusion index of countries where the largest COVID-19 problems exist, and you look at that. A diffusion index measures the breadth, the number of countries that are reporting the cases, and you can see that you had the first wave, and now you have a slow build up of the second. But this is a very, very strong indication of the infection rates spreading across the world. And then the change in active cases, the broken line, is giving you a sense of where the most pressures are on policymakers. And the only reason for looking at that is to the extent that you can look at that and say, well, all right, I think there's going to be more policy easing. In the case of the United States, for example, what are the pressures on the US government to come up with a new fiscal spending package, another $2 trillion or whatever it is that the Democrats want, as opposed to what the Republicans want? I mean, that tells you the United States version of this is available in that chart pack that you can pick up off our website for free, and it gives you some insight. Now, the other way of looking at of COVID data in a systematic way is to actually try to get a sense of how severe are the public health countermeasures. Now, you can do that in two ways. One of them is to try to track the policy measures themselves, and there are a number of people and institutions that have tried to do that. We find that it's actually not a very helpful way of looking at it to score the severity of the public health response. A much cleaner picture comes from these alternative measures of real-time data. In this case, comes from Google. These are so on the top panel, I'm showing you the daily change in the cases, but then the three bottom panels. This is the Google Mobility Report. You can pick that up Google directly, or you can go to our website and pick it up. And this is telling you that, look, this is what happens. That by tracking where people's phones are active, they say that, yeah, in residential areas and in the parks, that we are still running ahead of what we would, what we had at the beginning of the year. Whereas groceries and pharmacies basically running where they were since the beginning of the year, whereas other retail and recreation, had a big drop because of the first wave of countermeasures recovery, and now it's beginning to deteriorate again in the second wave. And the same thing in particular with workplaces and transit stations. Okay, so this is telling you again whether people are commuting to work or not. This kind of a framework does provide you some sense of where economies are heading, but a large number of caveats apply, right? The first is that this kind of data, first of all, is not robust. It comes from a commercial source. It hasn't been back tested. We don't know anything about seasonality. And the statistician, I could, spend an hour telling you how terrible this data is. So in a real world, as an investor, you look at it and say, okay, it's telling me something, but I don't need to get too hung up about it because ultimately what matters is fiscal and monetary policy. So I think hopefully that summarizes where we stand on how to use COVID data and how to approach it and what the implications are for our day job, which is to look at asset allocation and the relative performance of different asset classes. And ultimately, it comes down to it's the policy, it's the liquidity that is generated here that tells us something about asset classes. Now, second question, global instability. We have an awful lot of global instability. You've obviously been reading the headlines overnight. We have a highly contested election in the United States, which was, it's broken. There were two major predictions here coming into this. One of them proved to be untenable. The other one proved to be accurate. The first prediction was that this would be a slam dunk, and the candidate Joe Biden would not only have a clear path to victory, but he might even have a landslide, and that also possibly a blue wave, a so-called blue wave, would be carrying the Senate. Well, that turned out to be wrong. The races have been much tighter than was expected. But what turned out to be correct was the second observation, which was this would be a highly acrimonious election, and that quite likely the current President Trump, would contest the validity of the election and claim victory before he had the victory, or push things to the Supreme Court or whatever. That seems to be turning out. So we have a very unpleasant global backdrop here coming out of the United States. But I want to make a bit more of a general statement here about the global backdrop. First of all, we've had, for the last 4 years, we've had a great deal of protectionism building up everywhere. My first point to you is that protectionism as such is a symptom and not a cause for the cause of globalization, right? It's not protectionism which is causing globalization to slow down as such. Protectionism is the symptom of globalization's impacts, and it's the major impact being income inequality. And that income inequality drives protectionism, because income inequality underpins populist politics, and in particular highly aggressive foreign policies, where leaders can use foreign policy as a way of distracting their own population from issues. So that it would be misleading to think, oh, we are in a series of tariffs are coming in here which are somehow slowing down the globalization process. That's actually not a helpful way of thinking about this. It's the income inequality which is driving the whole thing. And before, let's give you a couple of pictures here that you might want to look at. I'll come back to the instability in the Middle East as well. This is telling you globalization on the left-hand side. This is the exports as a share of global GDP. This global exports as a share of global GDP. I could take this chart back 100 years, but I'm just showing it to you since 1985 or so. You've had exports rising as a share of GDP during all the way through the 80s, the 90s, and the 2000s. That's really the emergence of China. That's really the emergence of the WTO. You see this big period of globalization. Then you see that exports to GDP flattened out from about after the global financial crisis of 2008. And at the same time, you saw in same lockstep, you had, as this globalization increased, you had essentially inflation being squeezed down, this large disinflation, real unit labor costs dropping at the same time. That process of globalization creates all kinds of stresses. It translates into low inflation, but it also squeezes labor costs because corporations can use lower labor costs, cheaper labor in economies that were opening up. So the question is then, as globalization, if you like, peaked and flattened out, you saw the end of that disinflation process. So then now the question is, if we are entering this period of deglobalization, does that mean that if global exports fall as a share of GDP, does that mean that we also have now rising labor costs, rising inflation? Well, perhaps yes, but the question really is, will you end up with this thing falling down? In other words, the ratio of exports to GDP falling down. That you have to go back historically and look at what happened in the previous big wave of globalization, which is, I guess, from about 1850 to 1914 in the world. You had a very similar picture taking place. And then in 1914, you went into a deglobalization phase, right, where the world closed in on itself. Of course, we ended up with the Great Depression in the process. And you did not have real wages rising, by the way. You did not have inflation rising during the Great Depression, right? So in theory, then, if you looked at this and you said in the worst possible case, of a rerun of the 1920s and 30s, we would certainly see deglobalization. We would see a great deal of stress. We would see the rise, we would see world wars coming out of it, but we would not necessarily see inflation and higher labor costs. But what the bigger question really is, are we actually going to go into deglobalization? I mean, right now, we are in a stage where the global economy, from a cyclical perspective, is beginning to bounce back. Exports are beginning to recover quite sharply, and we are not seeing, in other words, this chart here looks like, if I was to bring it forward in real time into 2020, 2021, it looks like it's going to start rising, not falling. All right, so that just means that there's more political pressure, to continue with protectionism. The other outcome of this whole thesis is that you have rising inequality. Now, this is in developed markets and the OECD. This is the Gini coefficient. You may be familiar with that as a measure of income inequality. And in line with this increased globalization, falling labor costs, obviously you end up with more inequality going on in the developed market world. And in the emerging market world, of course, you always have rising inequality as people move from being extremely low income countries to being middle income countries. That's a very typical process. In absolute terms, people are being lifted out of absolute poverty, but in relative terms, within these economies, you have a great deal of millionaires being created. But that in a sense doesn't create the same kind of instability, political instability that it does in the developed markets. Okay, so let's go back then to the first point, and I wanted to discuss this idea of the Thucydides trap. I don't know if you're familiar with this concept. This is, again, I think it's a useful framework to understand as a tool, rather. It's useful as a tool to understand the dynamics of the great power relationships between the United States and China, but it's wrong as a framework. What does it say? The Thucydides trap is based on some historical observations and says that when you have a rising power that challenges the hegemonic power, that inevitably leads to war, because the hegemonic power misreads the intentions of the rising newcomer, and the newcomer then becomes extremely defensive, and both sides become extremely defensive and start misreading each other's intentions, and that inevitably results in war. And therefore, you look at China's rise from the 1980s onwards, and according to the Thucydides trap thesis, that is inevitably putting us on a path towards a global struggle between the US and China. Of course, there's some evidence that struggle has already started in earnest. I would just point out to you that there is, the Thucydides trap does not actually have as much historical support as its supporters claim, but it does help us in a kind of game theory context. It really does help us to understand what's going on in terms of the messaging from Beijing versus Washington, and how each side interprets the other side as being aggressive. So from Beijing's perspective, the US is being aggressive. From the US's perspective, it's China that's being aggressive, right? So both sides are misreading each other, perhaps, or casting, aspersions as to them, and that actually intensifies the risks of instability. Bear in mind that the world is extremely integrated economically, and that the economic costs of driving this kind of Cold War into further are extremely high for all sides. So you would look at this and say, all right, there seem to be a number of pretty good interests involved here to dial back the rhetoric or the action, and maybe just keep it as rhetoric, and recognize that both sides are using the struggle with each other as a way of gaining domestic political legitimacy, right? So that from the US perspective, whoever emerges from today's election as the winner is bound to continue making angry noises about China. From the Chinese perspective, President Xi Jinping, of course, doesn't have to face elections, but his own legitimacy is based on the notion of being a strong leader, and so he is bound to continue making angry noises about the United States or Canada or whoever, the West. And so that kind of rhetoric won't go away. But the actual, on the ground, in terms of real policy, we would argue that Perhaps there's room for pause here, given that global growth is so weak and that China is actually the leader of global growth at this stage. I don't think the rest of the world is interested in stirring a big fight with China in this particular context. Now, having said that, let's have a look at some of the implications for MENA arising from this. The first point I'm making is that that the disengagement of the United States from MENA in general terms should not be attributed just to Donald Trump, right? This is not a Trump-oriented issue. This is something much deeper, much more structural, which is that the U.S. Is self-sufficient in oil production for the first time in many generations, and it just doesn't need the Middle Eastern oil anymore in the same sense, right? So it's looking at it, and you have to understand it that this is in some sense the denouement of the twilight of the oil industry, and in particular the fact that the U.S. is self-sufficient. Why should they be involved? Now, U.S. policy regarding MENA itself is also at a crossroads, right? I mean, they disengaged from Syria and Iraq, having gotten involved and then disengaging rather precipitously. The question then is, what are they going to do next? Can they stay disengaged? Well, the answer is that you can't. It's probably too late to try to re-engage. There's a credibility problem that whoever takes over. The third point is that so you have to get used to, in MENA, you have to get used to much less of Uncle Sam than you've had in the past, and I'll deal with some of that, the implications of that. Then you had a first-term Trump that was highly transactional and who made deals, and those deals that he made failed actually to make Israel more secure. I mean, he promotes himself as being pro-Israel, but I mean, Israel still faces the same threats to its existence, primarily from rockets in southern Lebanon controlled by Hezbollah, and that threat still exists. And that's an existential threat for Israel. Of course, the potential for an Iranian nuclear program also still exists as an existential problem. Mr. Trump chose to contain Iran and pull out of the nuclear deal. Future historians will decide whether that was wise or not, but it certainly has failed to contain Iran. Now, things like attacking finding and killing General Soleimani, that kind of action actually doesn't make anybody secure at all, right? I mean, it's great for headlines, but all it does is it removes. I mean, if you have to think of the classical Greek myth of the Hydra, the many-headed snakes. Once you cut off the head of the snake, you suddenly find that two more have been created. Ultimately, what it means is that the various coalitions in the so-called Shia Crescent that had been controlled by the Revolutionary Guards of Iran, that there is no strong central control anymore. So suddenly you now have to face much more autonomous actions from people like Hezbollah in Lebanon, or the Houthis in Yemen, or Hamas in Gaza. These are all they in some sense they had a kind of a paymaster in General Soleimani. They no longer have the paymaster, and they start acting autonomously. That leads to more instability, not less instability. Now, if we have a Biden administration coming in, it's clearly he's given a strong indication that he would want to reset relations with Israel, with the Kingdom of Saudi Arabia, and with Iran. Now, the problem is, in all cases, there is a gigantic credibility gap here in order to try to reset those relationships. But what it comes really down to is as follows. Uncle Sam, the United States, is essentially pulling back from the Middle East. That is a structural long-term issue. The result is that the local players in the region and a few outside players as well, like Russia and Turkey, everybody is pursuing their own interests here. And ultimately, what it comes down to is you have an axis, as you well know, sitting in where you are, you have an axis that is a conflict within the Sunni world over the role of Salafist politics and theology, which translates into a kind of Turkey versus United Arab Emirates, with the Kingdom of Saudi Arabia allying itself on the United Arab Emirates side, and then Qatar on the other side. But that cleavage that exists in the Middle East, that's just a symptom of the hegemonic power pulling out of the region and you end up with this internal division. Now, what the net result of that division is, of course, it gives a free pass to Israel to do what it wants, to Iran essentially to do what it wants, to Turkey to do what it wants, in the South Caucasus or wherever it is. You end up with these different regional actors having a lot more autonomy to act in their own narrow national interests, which ultimately creates a great deal more instability. So we are having to live with that. That is part of what the world, the investment world that we live in, and it's background noise. From time to time, this means that there's going to be volatility jumping up, but it doesn't, at the end of the day, fundamentally change the overall equation. All right. Third point. Where is there growth in the world? Where is it, and where are there earnings that you could get out of it? So the first, let's start off with the first observation. Don't confuse secular and cyclical trends. Right? There's a lot of stock market investors, I think, are looking at the performance of internet stocks, for example, and say, oh, this is a strong cyclical recovery. Some say, and the others say, oh, no, this is because the world is going online. That's a kind of secular argument that the world is going online versus the cyclical argument that, oh, look at Tesla's quarterly earnings or Alibaba's quarterly earnings. So there's a great deal of confusion going on there between secular and cyclical trends. They're warning you about that. But the cyclical strength that we are seeing everywhere in the world is really largely limited to semiconductor earnings. If I'm looking at actual earnings and where are the earnings growth, it's really in semiconductors that's purely cyclical. A lot of the other things that you see can be attributed to long-term growth factors. Now, the third point is that it's China and the rest of Northeast Asia that are leading the growth rebound. It's absolutely the dominant driver right now, but that global growth rebound coming out of China in particular is being led by services and technology. It is not the traditional China big bounce, which we saw in 2017 or in 2004, for example, where China grew rapidly and it was a huge boost to commodity prices around the world, right? So this is a very different kind of growth driver. Yes, it's China, but it's not bad for commodities, but it's not necessarily the same story as we've seen in the past. Okay, so it's an early days for an earnings rebound, basically. That so far, EM, which ultimately means China, Korea, and Taiwan are leading the way, and it's thanks to semis. Let's have a look at this. This is global earnings, meaning developed market earnings in level terms. You can see that it's really all in the U.S. listed stocks historically, and rather than the global ex-US. But notice that the dramatic drop, the COVID drop in earnings, that is, in some sense, much smaller than the equivalent drops that we saw during the global financial crisis. If I look at it in terms of emerging markets versus developed markets, this is now the solid line here is the level of emerging market earnings versus developed market earnings. So you saw a big run up in developed market earnings in 2017, 18, 19. You didn't have the same thing so much. You had a run up here in EM associated with the big China growth rebound of 2017, and then it started fading. Both of them were hit hard by the pandemic. EM is recovering faster. If I look at the same thing in momentum terms, yes, both of these earnings levels are recovering, but year-on-year growth rates are still declining here, but the second derivative is improving. But if I looked at it in the EM relative to DM, you can see that EM is recovering faster than DM. All right, what is that? It's ultimately, I'm going to tell you, it comes down to tech, but let's have a look at where the economic growth is now rather than the earnings growth. And you can see it's really all, you can see it's pretty much all China. This, I'm showing you some PMIs on the top panel for manufacturing. These are the local measure and then the market measure. Services, the market measure came out even stronger today. It's not in the chart yet. And in these are Korea and Taiwan. Notice that Korea, actually, the decline in Korea happened a bit earlier because Korea was hurt in the very early stages of the COVID compared to Taiwan. And the recovery in Korea came later than Taiwan. So Taiwan had a very successful brush with COVID compared to Korea. Korea was still very successful compared to Europe and the United States. But nevertheless, they are both in expansionary territory, as is China. This is really where all of the growth is in economic momentum terms. If I looked at it in terms of where would I find earnings growth in the EM world, this is our indicator for bank earnings. I'm showing you China, Korea, and Taiwan is the known MRB indicator. It's telling you that really it's not in bank earnings, and banks, they offer a good proxy for domestic earnings. They are improving in Korea, but it's pretty much flat in China, and it's fading in Taiwan. That is not, so it's not really a story of bank earnings growth. If I look at the actual growth of the earnings, I can see some pickup here, but this is because of base effects, obviously, because they were so weak before. The earnings indicator is the more reliable view. So it's not really a domestic earnings story in Korea, Taiwan, and China, but it definitely is, a tech story. So this is the overall bank forward earnings for Korea and Taiwan. Of course, you know that those markets are highly tech oriented, along with export orders for electronic products. And you can see that's really where all of the excitement is in earnings, rather than in a domestic context. So that's another way here of looking at growth and pointing out just how different China is from the rest of the world. This is showing you the broad EM universe here, and let's focus on the bottom axis. The data comes from the WEO of the World Economic Outlook from the International Monetary Fund. They just released a couple of weeks ago their forecasts. They do this twice a year. So we just took their numbers. We didn't add anything to it ourselves. We just took their numbers and said, all right, let's take which countries are going to have a level of GDP higher than their pre-pandemic level. So let's take, if pre-pandemic is defined as the end of 2019, by the end of 2021, which countries actually will have increased, being ahead of 2019? Well, first of all, China is the only country in 2020 that is going to have positive GDP growth, right? So that's the first point. But by the time you get to adding next year's growth, where there's going to be a relatively strong rebound in China, you see that China is way out. It's completely in a different universe. Well, maybe Vietnam is there as well. But these are the countries which have essentially significant GDP growth over the 2-year period. Everything on the left-hand side of this chart is the countries that don't even get back to their 2019 levels of GDP by the end of next year, right? Now, remember, it's important to recognize that there's going to be some strong growth numbers. For example, India is going to probably record 7-8% growth next year, but it still won't get it back. Indian GDP still won't get back to what? To the level that it was at the end of 2019, right? So that's a way of understanding where the growth is coming from. And then that's the vertical axis is measures of debt to GDP, and essentially saying, all right, which countries already had high debt to GDP and have increased their debt to GDP. Obviously, the weaker countries are here in this top segment, where we would say that they have high debt and they still, are challenged by growth. The stronger countries here, high growth and high debt. Obviously, that defines China, that defines Malaysia. Absolutely high growth, but also high debt. So you don't have to worry about it. Now, remember that 60% of global GDP growth in 2020 and 2021, the 2 years together, will come from China, according to this data, right? And China is now 18% of nominal dollar global GDP. This is not in PPP adjusted terms. This is just nominal US dollar terms, which typically is quite harsh as a measure for emerging markets. Usually you would want to look at emerging markets in PPP adjusted terms, but just in terms of global trade and overall global growth aggregates, obviously nominal US dollars is the way to measure it. And 18% is beginning to nibble at the US share of global GDP, which is something like 22%. So China is a gigantic player in the global economy, and it's providing pretty much all of the growth. I mean, 60% of the aggregate global growth, and it's coming out of that country. Now, we are now going to go into looking at some asset pricing, and I will point out that, in fact, and as I already did, that Chinese growth is not coming in the traditional way, in the sense of being highly commodity dependent. All right, so let's look at asset pricing here, and here the question is we've seen some pretty rich valuations, and the markets have actually done remarkably well. They look in aggregate terms. So is the market looking at this, all of the stimulus that they're getting from the policy countermeasures and saying, oh, thank you for the stimulus, but I'm actually now really quite excited about stocks because I see earnings coming back. I'm anticipating the 2021 recovery. Or is this just looking at all of this stimulus that has gone into the market and saying, oh, we've created a bubble? So there's two entirely different, mentalities that you can take, or interpretations that you can take in terms of current valuation. Now, the first point to make is, look, it's undeniable that near zero interest rates, pushes investors into stretching for yield, into higher yielding options. That means they're prepared to take more risk. That's the first. That was what the policy was designed to do in the first place, was to ask, to get investors to take more risk. And there's a TINA mentality, what we call it TIA. TINA means there is no alternative, right? So in some sense, people are being pushed, being forced into into getting any kind of returns, whether that comes from growth stocks or from high yield. Either way, they're looking for something that will give them some oomph, some pickup in a world where growth has been highly constrained by COVID, and where interest rates are pretty much close to zero in developed markets. So in this era of uncertain growth, you can look at what investors have preferred in terms of their revealed preference. It's clear that they've gone for some notion of quality. Essentially, it's high. Maybe if they could call it, some people might want to call it quality growth, but it's essentially some notion of quality, however it's defined. The second, which is of course different from stretching for yield, right? Stretching for yield means that you take more risks, you're prepared to go into lower quality stocks. But in addition to that, if you can find growth that is also quality oriented, then you double up and like that even more. Then that creates the third point, which is the dominance of mega caps, right? So who are these mega caps? In the developed market world, it's quite clear. They're concentrated almost entirely in the United States. They're the so-called FANG stocks: the Facebook, the Alphabet, the Apple, the Google, the whatever, right? The big names. These mega caps absolutely dominate in the United States. It's quite obvious that in the case of the emerging markets, you have a similar factor going on. These are Chinese names, the likes of Alibaba or Tencent, Mehran Nakhjavani, same kinds of names that you have in the US, similar types of sectors where they're involved in, communications, media, consumer discretionary, technology. Those kinds of names are becoming absolutely dominant in terms of their market values, and that is distorting all of the stock indexes and valuation aggregates. So you have to be careful about how you use those aggregates. But in the EM world, in terms of evaluation, there is a clear trade-off, right, between the good quality is expensive, has become expensive, and the poor quality is where you get the valuation opportunity, which is actually an entirely logical relationship. So looking at those general points, I would say be careful about just dismissing everything as a bubble, because if it was a true bubble, then there would be no differentiation between valuation and risk. You wouldn't have the preference for quality. So there's something a bit more than just that. Whether it's anticipating an earnings rebound is also unlikely. The market has proven itself to be pretty bad at discounting future outcomes in the last since the global financial crisis. I would say the notion that equities is a long-term investment, which is completely correct from a theoretical perspective, that you have to look at discounted cash flows and all of that. It becomes a little bit more challenging to use that theoretical framework to explain investor behavior in a time of plentiful liquidity that we've had really ultimately since 2008, but in particular in the current context. But investors, generally speaking, are not able to handicap future returns very well. So let's have a look at some charts here. On the left-hand side, I'm showing you our own valuation indicator. We've split the EM world into net commodity importers and net commodity exporters. All you need to know here is just take a look at the top, this top panel and the middle panel. We would argue that in the commodity importers, net commodity importing economies, you're already pushing the bounds of reasonable valuation. You're inexpensive, what we would call dear territory, but not into frothy territory yet, but we're getting there. If I just look at it in absolute terms compared to its own history, we're absolutely in frothy territory. In amongst net commodity exporters, however, look at it. You're well below. You're in cheap territory, and in some cases, you might even say it's a bargain territory in theory, and just purely valuation, right? This is not relating to. I'm not discussing whether this is a value trap or not, but I'm just making the case here that the net commodity importer economies, which are essentially, China, Korea, Taiwan, et cetera, that's where you get the expensive valuations, whether you look at it historically or compared to developed markets. And in the commodity exporting economies, the likes of Brazil and Russia, et cetera, South Africa, that's where you get the so-called cheap valuations. Now, if I look at it in global terms, this is a 12-month forward PE. Similar, it's the US which has the spike in the P. So the US broken line here, the 12-month forward PE ratio comfortably in excess of 20. This is bringing back memories of the tech bubble and the Y2K and all the rest of it, the TMT mania back in to early 2000s. Whereas if I look at global ex-US, the green line, I'm still well below those kinds of frothy levels of that we had during the tech bubble. If I look at US divided by global ex-US, this is essentially the premium on US stocks, if you want to put it that way. There's been a steady uptrend. Now, of course, when we say US stocks here, we're talking about companies which are based listed in the United States. I mean, Apple or Google, yes, in theory, they are, of course, listed in the United States and they're incorporated in the United States, but are they actually a representative of the US economy? No, they're global companies, right? They just happen to be based in the US and listed in the US. But so we have to be careful here to distinguish between, this is not a vote of confidence in the US economy as such, this is a vote of confidence in the stocks which happen to be listed in the US that are the big global players. So that's essentially where we are in terms of valuations in stocks. I'm just going to have a look at a few other things. I'm showing you some credit here, and we're seeing in corporate bonds, this is the OAS spread, the high yield pretty much at its long-term average here, investment grade at its long-term average here. That is actually not nearly as neutral as it sounds. In a period of extremely attractive valuations, you might be expecting to see. When people are stretching for yield and going into high yield, you might have expected to see these spreads being well below their long-term averages, but they're essentially at their long-term averages, which tells us that if you have to be in fixed income these days, you really have to go into credit products, especially as the global economy is going to be improving next year. If I look at it in EM only terms, I'm splitting you here between the top half of the page and the bottom half. This is local currency denominated bonds. Again, looking very similar to the previous one. This is the spread over US Treasuries now. And it's essentially at its long-term moving average. You're getting a 400 basis points. Now, of course, when you're taking local currency debt, you're taking currency risk as well as yield curve risk in the EM world. But essentially, it's telling you you're pretty much at long-term averages. Whereas in dollar-denominated debt, which is the bottom half of the page, this is the hard currency denominated debt, which is about 50% comprised of oil exporters. You'll see that the spreads are well below their long-term average. So this is saying that too much money has gone into this segment, and I'm going to point this out in a little while when it comes to MENA as well, which is that this actually, because the EM dollar debt universe is dominated by oil exporters, you would have to. This seems to us to represent some significant source of risk on a maybe 3 to 5 year basis, not necessarily on a 1 year basis. On a 1 year basis, you would still hold this because it's going to give you more than US Treasuries. But there are some causes for concern here. I'll show you some of the debt ratios associated with that in a while. What about EM currencies? Are they cheap or expensive? Well, they're being beaten up. they're bouncing back. And when you include the higher carry, the bounce back is coming much faster than if you just look at the raw indexes. Bear in mind that when you look at EM currencies, everybody gets confused. There are two big benchmarks that are associated. There's an MSCI benchmark for EM currencies, which of course is about 40% weighted in China. And that's the decline during the big risk off in the pandemic was relatively minor, and the recovery is steady. Then there is the bond weighted index, which is from the JP Morgan index, where you had a very sharp sell off, and the recovery hasn't been as easy because it's including a much larger number of more fragile currencies. So it includes things like the Argentine peso, the Turkish lira, et cetera, et cetera. So there is this recovery in the bond-weighted currencies, is much less pronounced than in the equity-weighted. So in the middle panel, just why the reason that we expect it, we refer it. It's ultimately equally weighted, and it tells you the bounce back is coming. And of course, the other thing it's telling you is that the backdrop for this bounce back is very, very favorable. We have a soft US dollar. I'm showing you the DXY index inverted here, and you can see this kind of turnaround here is associated with a softening US dollar. We would expect the dollar to modestly soften going forward as global growth increases. Remember, when global growth improves, generally speaking, the US dollar declines. People rotate out of the US into non-US assets, and that helps that process. So let's come now to EM local bonds and see where would you find cheapness and expensiveness here. It's a mixed bag. In broad terms, we would say that EM local currency bonds are pretty attractive, or they're okay. They're not stretched. They're offering significant yield. But within the EM world, if I take our currency indication, our currency valuation indicator on the vertical axis against the real yield, you can see that here the poor quality you're paying for, you get what you pay for, right? Now, this is countries which have very high real yields as well as extremely cheap currency. So Colombia, Russia, Brazil, Turkey. Brazil is our favorite, and Russia is where we are placing our biggest bets here in that component, because we don't think that there's going to be a significant EM debt crisis. Up here, you have the problem sheet. These are countries, emerging market countries, which are pretending that they're developed markets by having negative real yields and overvalued currencies. India is something to watch out for in that respect. Okay, but in general terms, we think that EM local currency debt can outperform significantly in a global fixed income portfolio. We would hold it at max zone overweight. So let's come to oil now and really ask what the outlook is. This has a big impact on your view in MENA. I would make a few points. The US can restore half of lost production without even hitting the break-even price. I'll tell you why. OPEC plus, that means essentially Russia and Saudi Arabia, will grapple with excess inventory for as long as demand is uncertain, and demand will stay uncertain for quite a while here. All producers need to monetize their reserves pretty rapidly in the face of the stranded oil thesis. So, obviously increased ESG investments, which are raising the cost of capital for them, and of course the competition from alternatives. So that they need to monetize their reserves. That ultimately puts pressure on them to get the oil out of the ground and sold and converted into some kind of a sovereign wealth fund. There is an unhappy equilibrium which will keep capex subdued. This unhappy equilibrium means that the marginal producer of oil in the world are the US shale producers. They are the highest cost from a technical perspective, and their cost of production, essentially their break-even costs, will determine what in very broad terms, what the price of oil is going to be, and that break-even cost is really too low to allow for a sustained capex buildup, but it will actually keep prices range bound at the same time. And of course, whenever you see a period of time where capex is constrained, you start looking for the possibility of the next oil price boom. In other words, and I'll show you a chart that looks at that. So let's go through this very quickly. I'm showing you, to start off with, I referred to this before, looking at US dollar bonds. So this is international debt securities outstanding for all emerging markets as a share of their GDP. For emerging markets, it's 10%. For the oil exporters in the emerging market world, it's more than 20%. Right? So these are just the bond issuance only. Global bond issuance. This is US dollar mostly bond issuance, and that, so you can see that it's the oil producers which have the biggest problem here. Potentially, the $1.5 trillion of external bond issuance. It's also very vulnerable to either lower oil production, or lower oil prices. In other words, lower oil revenues. Now, let's start off with the US shale producers here and make one point. This is total well production in the well completions and production in the US. It's beginning to come back. It's already, the last data point actually is around 11 million barrels a day from 13. It dropped down to about 10.5. It's coming back pretty rapidly. We expect to see, in annual terms, that over the course of this year, the oil shale output will recover. This is despite the fact that oil prices, this is the 24-month forward here, the oil prices are well below what the theoretical break-even price in the US. Why is oil production beginning to come back without oil prices even meeting their $50 a barrel break-even price in US shale? The reason is because there is something called the drilled but uncompleted wells, the DUCs. There is a large inventory of oil wells that have been drilled already. Remember that drilling takes about 1/3 of the capex cost of a shale producing well, and 2/3 of the capex is associated with the completion, in other words, of the fracking. And so if you've done that, if $50 is your break-even price, but 1/3 of it has already been spent, and you have an inventory of these drilled wells but not yet completed, that means that actually you're, in the short term, at least on a 6 to 12-month basis, you have enough inventory of these drilled but uncompleted wells, these DUCs, that you can actually start completing them at prices of 35. So we're above 35. It's quite clear that oil prices are going to come back. They are beginning to come back. That puts pressure on everybody else. Of course, who are the Russians and the Saudis, or the OPEC Plus group. They have to now decide how much to allow back in, and how much to continue restraining their oil production, and how much to allow a sense of normality of return. If I just look at stocks, stocks are telling us the same story, that we had a tremendous increase in stocks, whether relative to long-term average or relative to consumption. Tremendous increase during the peak of the slowdown in oil demand. These stock levels are beginning to come back, but they're still very, very elevated. There's still plenty of excess stocks, which tells you something about overall demand, right? So demand, remember, supply has been constrained. The US are beginning to produce more, but so OPEC Plus has to grapple with this problem of whether to increase their own production or not. They're quite likely, we would think, that they're going to have to be really forced to continue the cutbacks. It's going to keep them under pressure. This is why we call it an unhappy equilibrium, all right? Because from the shale producers' perspective, they are actually, they can just barely survive here at $35 a barrel for a short period of time while they have DUCs. They're not particularly happy with this price, and OPEC Plus is not happy with having to tighten their belts and constrain their production because there's still so much excess supply in the world, and that's why it's an unhappy equilibrium. So when will demand come back? Well, the IEA gives us some ideas here. The good news is in petrochemical demand is coming back to pre-pandemic levels next year, they say. That's good news for people like SABIC. But for everything else in terms of oil demand, the outlook is much bleaker, right? So for diesel and bulk fuel oils for shipping, that kind of demand doesn't get back to pre-pandemic before 2022. Same thing with passenger vehicles. That won't get back until pre-pandemic levels until 2023. For aviation, it doesn't get back to pre-pandemic levels until 2025. So you're going to have a continuing constraint on demand for quite a while. Now, what is the overall implication here? Why do we? I mentioned that there's an implication here for capex and when will we see the next potential run up? Let me give you the framework in this chart. I'm showing you oil prices in real terms. I'm just taking total oil spending as a share of GDP. So oil demand multiplied by the oil price divided by GDP. Over time, this is going back to the beginning of OPEC. So you have these periods where we had expensive oil, then we had cheap oil, then we had expensive oil, and now we're in another period of cheap oil. And then showing you some measures of capex. This is U.S. capital expenditure. When oil is expensive, people spend money on capex. When oil is cheap, they don't spend money on capex. Another way of looking at capex is rig counts, global rig counts. Same general picture. So this is the big shale boom here. Big capex during an expensive period of oil that created the excess supply. We ended up with the end of the conventional oil era, 2014, 2015. Oil prices crashed. Capex picks up in the U.S. Why? Because this is still shale oil dependent. In the rest of the world, what happens? This is now a global ex-OPEC and OPEC. The green line is OPEC in terms of drilling counts. What happens here after 2014? The crash in global capex as proxied by rig counts. It crashes down, a little bit of a recovery, not much. Whereas OPEC rig counts, look what they do. The oil price crashes in 2014, 15, and there's a little bit of a reaction here, but rig counts continue to rise. Why? Because the OPEC producers are needing to monetize their reserves. They need to dig the oil out of the ground and get it to market. That kind of dynamic is very, very powerful. Now, of course, this data is showing the big drops that we've seen post pandemic, and as I mentioned, what drives these periods from cheap to expensive oil? It's a very simple model that you can look at. When you have an extensive period of cheap oil and low capex, right, you eventually end up with not enough producing wells in the world, right? You start running out of oil, quote unquote, running out of oil. All it means is that for the previous decade, you didn't spend enough money on exploration and development. And then you start running out of oil and the price rises. And because the price rises, then people have an incentive to start spending on capex, right? So that dynamic in the period of cheap oil, you're looking at this and saying, okay, how long will this take for a period of cheap oil to continue to create the dynamic for the next run up in oil prices? It's a theoretical possibility, even in a world which is weaning itself off oil. It's still possible that we could end up with a period of maybe a relatively brief period where the world thinks that there's not enough oil. But that is definitely not going to happen in 2021, and it's very unlikely to be happening in 2022 as well. So I wouldn't be betting on another bull run in oil prices over the next 24 months for sure, or even though theoretically, I would say that yes, sometime in the next 10 years, it's quite possible that you might have such an event. But it's going to be a relatively short event compared to history, because clearly the dynamics of global demand have fundamentally changed here as we move into a new economy. All right, so just quickly, let's look at some of the implications for MENA of all of this, and I would make the following points. There are two global factors that drive portfolio returns for MENA. Ultimately, these are the big picture factor exposures. One is global liquidity, one is oil revenue. So be very careful here. You have a lot of people who sit around, analysts who say, but there's a very low statistical correlation between the price of oil and MENA asset prices. Yes, okay, fine. That's I wouldn't expect to see a high statistical correlation. It does not mean that there is not a strong factor impact on asset prices. The factor impact is there, but easy dollar liquidity, which is what we have now, that definitely supports MENA currencies, especially if we have a weakening US dollar. So despite all of the concerns about low oil revenues, I wouldn't be looking for the pegs, especially the Saudi Riyal peg, to be breaking from time to time. Hedge funds like to jump on that trade. This is not the time to be jumping on anything like that. I wouldn't say there's any threat to the fixed currency regimes in the GCC. Outside, of course, we have two very, very weak credits in the GCC, Bahrain and Oman. But outside of those, I wouldn't be looking for any serious problems here. And certainly there'll be plenty of money available for interbank flows. Bear in mind that the markets, the banking markets in the Gulf and in the GCC, and in particular in the Emirates and Dubai, are very highly dependent on wholesale banking. There shouldn't be any issues there. There is no global banking crisis. There's no liquidity crisis that we had, for example, during the global financial crisis of 2018. And it's going to be fine. There's plenty of appetite for bonds, lots of bond issuance going on. But all of that is a very, very forgiving global environment. Now, the other thing to bear in mind is that when global investors look at MENA, they don't compare MENA to the EM as a whole. They look at MENA as being an oil-dependent region, and the common hurdle that they would look at is Russian asset prices and return. So it's not, you're not being compared to EM as a whole. You're being essentially compared to Russia, and Russia is extremely cheap. It's extremely cheap because of sanctions and all kinds of political risks. But so the problem that's actually quite a difficult hurdle to beat for MENA, right? Because you're constantly being compared to something which is actually already pretty attractive. The final point here is that for direct investment, right? You need there's going to be plenty of outflows from the MENA region, right? Because the need is in these the sunsets industry of oil. You need vertical integration. That's the only way you can make money, is to being an efficient producer with vertical integration, which means that if you're any kind of MENA government, you are spending money big time on making sure that you are vertically integrated in both the oil and the petrochemical markets with your customers who are primarily in Asia. So you're going to have direct investment outflows from the EM, from the MENA region, so that the FDI inflows then, are in net terms may not be that significant. And anyway, they're capped by demographics, the unknown factor being what will happen to all the foreign workers in the region. And if those demographics are, essentially are questioned by the foreign worker issue, it means that all of the inward foreign investments will be capped. So broadly speaking, we're in a positive cyclical environment for portfolio flows, but not necessarily for direct investment flows into the region. And with that, I think I probably overrun my time. But I just wanted to show you where we are in terms of the actual flows into the EM world. Bond flows are very, very positive here relative to equity flows, and that's what we're observing so far. We expect to see equity flows picking up, but remember that when you measure flows into the EM world, 2/3 of the EM is actually China, Korea, and Taiwan. It doesn't really affect MENA that much. So with that, I think I'll hand back to Rahul and see where we can deal with any questions. I'm sorry I kind of overrun my time.
I hope you can hear me.
Yep.
Oops, you can hear me in echo. Let me do this. Can you hear me?
Yes.
Okay, great. So thanks very much, Mehran, for that presentation. And we have had a couple of questions come in, so I'd like to put those to you. The first one, obviously, the big elephant in the room, the US election. We don't yet have a result, but what are your thoughts on whether it has any impact on the investment decision, or do you see it as a non-event? Do you have any comments on that?
Yeah. Look, I mean, the market was discounting a blue wave. The market had got itself into living with the idea that it's the end of Trump and we're going to have Biden, and it's not just going to be Biden; it's going to be a Democrat-controlled Senate. It's quite clear from the events of last night. We don't even know if it's going to be Mr. Biden, but it looks like, on balance, if he can win Pennsylvania, and it's not tied up in the courts, or at least if it goes to court, that the courts will be reasonably neutral. The chances still favor a Biden presidency, but it will be a very weak presidency because it's very unlikely at this stage that the Democrats gain control of the Senate, and even if they do, it would just be a very marginal majority that has historically been very difficult. So ultimately, you look at this election and says there is no strong mandate for whoever emerges as the president. There is no strong mandate. If Trump somehow engineers a survival here, he still faces a Democratic House, and if it's Mr. Biden, he will be hamstrung by a Republican Senate. So either way, no strong mandate. That means it's going to be really tough getting the fiscal package through. That's the most immediate issue. So this, we still have some uncertainty. I wouldn't be, I think the market will be having a hard time dealing with that uncertainty in the short term.
Thanks, Mehran. Another question, you've touched a bit on it, but MENA is quite a diverse region. We have oil exporters, oil importers, wealthy nations, poorer nations. From your perspective, in terms of asset allocation, do you have any strong overweight or underweight views on the region?
No, I mean, our from an asset allocation perspective, looking at the MENA economies, of course, when you look at in terms of benchmark weights, the benchmark weights really are very strongly focused on the Emirates, Saudi Arabia, and now Kuwait coming in, and Qatar as well. So in terms of benchmark weights, the smaller economies don't really figure. Egypt is too small. Bahrain, and it's a frontier market anyway. It's not even in the index. So you're really talking about those, and within that, you're talking about gigantic weights in banking, and that banking weight is expensive. In terms of other emerging market banks, the growth profile is not particularly attractive, and the valuation is not attractive. So that's the first problem, is that when I compare, if I'm looking at a banking system that is based in an economy that ultimately is driven by oil revenues, then I would prefer a Russian bank over a GCC bank, put it that way. So outside of banks, then of course I've got Saudi Aramco, but I would argue that that's an unsustainable story, a dividend play story, and it's unsustainable. They have to borrow in order to pay their dividends. I prefer Rosneft over Saudi Aramco. So again, you constantly end up by comparing it. Now there may be pockets, and I think there are some legitimate arguments that one say within consumer-oriented sectors, that there may be some interesting plays in the region. But broadly speaking, we would be underweight, simply because we could find a better opportunity with similar risk levels, in other oil-producing economies. Russia is number one, Malaysia energy dependent, Colombia energy dependent, with some much more attractive growth profiles and more attractive valuation profiles.
Thank you. So we have another question. Obviously, particularly in the developed world, we've seen a lot of fiscal stimulus packages. What are your thoughts on whether or not that successfully addresses the inequality issues that have been exacerbated over the last decade? And secondly, how will this fiscal deficit ultimately be fixed? What are the thoughts on how that gets addressed over the next decade or so?
Yeah, thank you. I mean, yeah, those are the best questions to ask. I think those are fundamentally what it's all about. Okay, the first point is that these fiscal packages that we've seen so far aren't addressing inequality in any way. What they're doing is plugging a hole. There's a gigantic hole created by loss of employment in the service sectors in these economies, and so governments are stepping in simply it's like a band-aid solution, right? You're not actually addressing the inequality, you're just stopping the inequality from getting worse at this point. Now, the question then is, how sustainable is it over time? Well, that comes down to whether you're prepared to admit, and there are very few developed markets which are prepared to even countenance this discussion. Are governments in the developed market world prepared to admit that this fiscal spending that they are doing ultimately is the back door to modern monetary theory, MMT? In other words, the idea that you can carry on printing money and just distributing it, as Ben Bernanke said famously, is helicopter money. things like universal income benefits, those kinds of things. That's the leftist ideology. I don't think there's many in the DM world that would countenance it. But the reality is that that's exactly what governments have been doing in a crisis situation, right? They've been creating money and putting it directly into people's bank accounts. So ultimately, they've broken the taboo of MMT. I think this is really an interesting political development. Now, MMT in theory could address, if it's introduced, it could address the inequality issues. The issue then becomes, will the markets believe that it's sustainable, right? Because it's going to result in much higher levels of debt. With bond yields so low, does that matter? And the answer to that is going to be dependent on country by country, but ultimately it's going to be dependent on inflation. Interest rates can only remain low if inflation is negligible. If inflation starts picking up for whatever reason, after all of this gigantic experiment in MMT, I would call it "quote unquote" MMT. It's not. Nobody calls it that these days, but that's effectively what it is. Then it's sustainable, right? Because a government can continue borrowing as much as it wants and spending it, and allowing GDP to grow in that way. From a purely technical perspective, this thing can carry on for a very long time. It's a political decision. It's not a technical decision. It's a political decision. Now, it's very hard to see either a Trump 2 administration or a Biden administration embracing MMT. MMT is a Bernie Sanders concept, right? It's very hard in the European context to imagine Germany embracing MMT. Maybe in a Scandi context, maybe, but it's again very hard to see that. Maybe France is probably the country where you would expect to see it first, but ultimately all of this is going to be dependent on European fiscal rules as well. So there's a huge institutional obstacle in the European Union to do that. So I think the reality is that we're living in is quite likely that as the further we go into 2021, the stronger the voices are going to be heard, political voices and policy voices saying we have to go back to some form of austerity. We can't afford to maintain this fiscal support. We have to move back to austerity. And I think we'll have to go through another round of that. And that's very, very painful because, even if the economies are beginning to recover, as soon as you start imposing fiscal austerity on it, you slow things down and you exacerbate the inequality. You create all kinds of political noise, which creates more pressure on populism, populists, et cetera, et cetera, et cetera. So it's a very messy situation from a political policy standpoint, even though technically there is a solution out there that one could argue may work if it's allowed to by inflation. So it really comes down to an extra source of risk for asset allocators, an extra reason for being super cautious about developed market government bonds, which are not at all priced for these kinds of risks, right? So it tells you, be very cautious, and that's the big takeaway. Be very, very cautious about U.S. Treasuries, about euro-denominated government debt, because this is not an easy problem to solve. We can't hear you, Rahul.
Sorry, I hope you can hear me now.
Yep.
So we do have one more question, but if anyone does want to send through a question, please do so on the chat. What Akshay is asking is related to what you've just said. Basically, can the US Federal Reserve print an unlimited amount of money? Because of the US dollar's reserve currency status, there's currently significant demand for US assets. And at what point does that sort of status quo break down?
we had a situation in post-World War II where the global economy needed reserve currency. Of course, it was a different world. We had fixed exchange rate, but nevertheless, there is still something that you could take away from it. Global central banks needed reserve currencies. They needed dollars. They wanted dollars. Everybody needed dollars. And it was a very scarce commodity because the US was running a large current account surplus. It was difficult to get your hands on dollars, right? So what did countries do? They ended up adopting as a reserve currency, as of course their preferred currency was dollars, let's call it gold, and they're forced to hold something that was much less attractive than gold, but it was available. And what was that? It was the British pound sterling, right? That why was that unattractive? Because Britain was in the toilet, economically speaking, right? It was a disaster zone. It wasn't growing. It was running gigantic. It was running into constant potential balance of payments crises. It wasn't productive. It had huge current account deficit. But sterling was available precisely because the UK was running a current account deficit. So what this tells you for today, in today's world, is that the role of a reserve currency is dependent on its availability as well as its quality. And the availability, if you look at the countries in the SDR basket who are potentially reserve currencies, right? Who do we have? We have obviously the dollar. We have the euro, current account surplus. We have the yen, current account surplus. We have the Swiss franc, current account surplus. And we have the renminbi, Chinese currency, current account surplus. All right, so ultimately, right, in the end of the day, if you want to switch your reserve currency role away from the dollar because you're afraid of political risks or fiscal risks or whatever in the US, or you think that the US is fundamentally in decline or whatever argument you want to use, that your problem is getting enough reserve, building up, finding enough non-dollar reserves to put into your, to convert your FX reserves into something other than dollars. Ultimately, dollars are available. So now, in this world, dollars become arguably the unattractive but yet available currency, reserve currency, whereas renminbi become the attractive. They're attractive from a yield perspective and from a growth perspective and from a quality perspective, but relatively difficult to get your hands on them because China runs a current account surplus and because the Chinese government is not yet fully internationalized the yuan. So you have exactly the same dynamic. People would love to have more renminbi or more yuan in their foreign exchange reserves. Sovereign wealth funds and central banks and global investors are absolutely obsessed with this. They're buying as many government bonds in China that they can get their hands on. Their share of the government bond market in China is rising precisely because of that. But the scale of that buying is still too small to threaten the US's dominance as a reserve currency. So for as long as China has a current account surplus, now in 5 years' time or 10 years' time, China will have a current account deficit. I mean, that's demographics are telling you that the Chinese savings rate is going to be falling. Maybe, I think on that kind of time frame, 5 years, 10 years, there will be a significant threat to the dollar as a global reserve currency. But in the meantime, in the world that we live in as asset allocators, right? You have to live with the dollar. You have no alternative, right? So it doesn't really matter in the end of the day. The dollar's reserve currency status is not threatened on a 6 month, 12 month, 18 month view by by what's going on with US fiscal policy.
Thank you. Okay, you can hear me. We don't have any more questions, and we are a bit over time. So I'd like to thank Mehran and your team at MRB for a fascinating presentation. Some great charts. We've covered a lot of ground in terms of big picture insights, a lot of food for thought. So thank you very much. Also, thank you to all our participants for joining us today, for sharing your questions. Just remind you that this event has been recorded, and we'll also be sharing the presentation with you shortly after we finish today. We will also be sending you a survey, so please do give us your feedback on this, and if you have any ideas for future events, please do share those. And then as a final point, this event does qualify for 1 hour of professional learning credit, so well done to you, and give yourselves a pat on the back for that. Otherwise, thank you. Have a good evening, and let's see what happens in the US over the coming days.
Thank you.
Bye-bye.
Bye-bye.